Let's turn to crude oil right now and energy prices. WTI dipping below 80 bucks a barrel ahead of a big week for energy. OPEC Plus, the partner countries, meet on Sunday, and the EU's ban on Russian crude going into effect on Monday. With prices currently near where they started the year, the Chartmaster himself sees more weakness ahead in the energy complex. Let's bring in Carter Braxton, CBW of Worth Charting, and break it all down for us. Carter, what are you seeing?
Thanks, Tom. Well, what we know, and let's just go right to the charts, is, of course, that crude oil spiked on the invasion of Ukraine, and that high is 130, 132. It touched a low of 73 and change. That's a 44% decline. But let's put some lines and arrows on and try to figure it out technically. So this is the exact same chart, and what we know, and this is important, right, is that we have been on trend, and we've bounced, close to trend. We bounced again, and now we've undercut. And while we've thrown back a bit, gone from 73 and change low to we closed almost at 80, the odds of real upside from here, I think, are very low. More importantly, of course, is the energy market itself in terms of the shares market. And this is the XLE, and this is the fascinating thing. Is it OPEC? Is it demand for oil? Is it supply? Or is it, and this is the beauty of it, to the penny, to the penny, to the penny, to the penny. It's very annoying to the fundamentalists. They don't like this, but to the penny, to the penny, to the penny. And so you've got like, hey, there it is. Guess what? Big commodity traders look at charts. I think energy, the double top is important. We want to be underweight. And here's the best part, I think. It's all about relative. Look at this final chart. This is the S&P 500 energy sector's relative performance, a ratio line, to the S&P. And once again, going back all the way to the peak, energy peaks and it stops and it stops and it stops, and it got to the penny, to this line, and energy is now, since the second week in November, underperforming the S&P by almost 700 basis points. We want to be underweight energy.
All right, underweight energy. An interesting point here. Carter, thank you very much for the charts there. We'll see you back here in a few for options action. So, Steve, you've been the guy that's been calling for $65 per barrel crude. You have been for a while now. It was a very bold call at the time. What's your take? Is the downtrend in place, and will we see that $65 target for you?
So to Carter's point, the downtrend is still in place. And whenever you hear OPEC say they're going to cut production, you want to be a seller of oil. OPEC said they were going to cut production October 5th, and it was their biggest cut since the pandemic. Those two spots on the chart, it rallied, spiked higher to low 90s, double top there, traded down to 73. That was in the face of an OPEC cut. Now OPEC says they're going to cut production again. So you want to sell it with both hands. The problem is the SPR is going to be replenished around $70.
That's the guidance that we're hearing. Yes.
That's the guidance that we're hearing. So what it does is it encourages commodity traders to buy ahead of the government buying it at 70. So your risk, if you're going to buy it, you can buy it at 70, 75. You can always sell it back to the government at 70 when they replenish the SPR. But even given all that, I think I have a shot at 65.
All right, 65. So Tim, I'll look at you for this here. If you look at the outperformance of energy, and Carter showed us the underperformance versus the S&P.
Yeah.
But there's been a big divergence in terms of energy stocks versus the price of crude oil. They normally track pretty closely, and that's kind of intuitive. But why are we seeing such relative strength in oil stocks as opposed to oil per barrel?
And I'm one of those fundamental guys that Carter says is going to get angry by his charts, but I'm not. And I would make, yes, I would agree. Energy stocks, XLE has underperformed the S&P by 10% since this run. XLE has outperformed the price of crude by 20% since October 1. The character change between energy stocks and the underlying commodity has been notable for 6 months, and the outperformance of the XLE to the S&P is over 100% since the beginning of the year. And there's a couple different things going on. One is that I say this all the time: energy equities are run differently. These companies are actually generating free cash flow. They're paying down debt. They are run differently. The S&P weighting is 4% in the S&P. I am sure, as Steve was at 65, I am sure that the energy weighting will be north of 6 by the end of next year, if not north of 8. What's going on with the energy sector is it's become more investable. I actually think that China, by the way, coming on board and energy demand is actually going to go a lot higher than people expect.
Courtney, I wonder, are there names, I think, when you talk about the companies most levered to oil prices. You often think about exploration and production companies, the upstream ones. Is there still a compelling value case to be made for energy stocks, oil and exploration and production energy stocks, even after the run that they've had versus oil prices?
I think Tim just brought up a really good point here, and I think what you want to look at is China is the largest buyer of crude oil, right? And we've just had so many false starts with when is China actually going to reopen, when is that demand going to come online? But it really is a question of when it's going to happen, not a question of if it's going to happen. So, how early you are is the question, but I do think that is going to be a huge opportunity that's going to go into energy here. And especially you add that to supply coming down, the dollar weakening. I mean, all of these things are actually bullish for your energy stocks, and they have come in so much more efficient. If energy prices are lower, they're still going to be profitable.